On Tax Talk, presented by Willis and Jurasek, CPAs and consultants. We have CPA Rick Schefferly. Hi, Rick. How you doing?
I'm doing great today, Bart. The weather's beautiful, isn't it?
Yeah. Thanks for taking time to be with us during your busy season. But this weather is kind of good for your business.
I think so. We always joke being a CPA in Michigan is a lot better to be a CPA than in Florida right now because if the weather's cold and nastier, our production is better in the office. People are less likely to sneak home and rake the leaves or enjoy the sun or go golfing. So the nastier it is, really probably the more hours we get out of our staff. So it's kind of fun. A little odd tidbit, but yes.
Awesome. And then when it's all over, the big celebration is even sweeter.
It is, absolutely. And you know, if you didn't love it, you wouldn't do it. So I guess at the end of the day, it's a pretty big challenge. There's a lot of compression and I don't know, our staff's up for the challenge, I guess, in the offices, and I think we all enjoy it, so that's what makes it fun.
Well, I know you guys are very productive because our CPA at Willis and Jurasek, Ryan, he's got everything all done. Way to go. Thanks so much.
Perfect. Well, we don't like extensions if we can avoid them. Sometimes you can't, but we just soon try to get the work out.
So you were telling me before the show that you field a lot of calls, questions, and all these what-if situations, and it happens. People they're wondering if there's something they can do to either avoid taxes or pay less.
Absolutely. You know, from clients to friends of clients to employees at businesses that we service, you field calls on a regular basis, and some of those calls in reference like inheriting a house. And I had one last week where a client's sister passed away and she passed her house on to the client's children, so she bypassed him and went right to the kids. And you know, he was calling with about a bunch of what ifs because the daughter's preparing her own tax return. She lives in Florida. What ifs? Is it taxable? Is it not taxable? And you know, if the house itself is transferred after the date of death, they get a step up in basis in that house, which basically means, you know, that maybe that sister bought the house originally for 50 grand, but it's worth 150 since there's been so much appreciation in the market that at the end of the day, that basis is going to be 150, and those kids will not pay any tax on that house. But they're going into it with that thought that they're going to pay a bunch of tax. So that's one of the scenarios. You know, the other scenario is a lot of people still remember the rule, and you may too. It used to be there was a provision in the tax code that you could sell your house once in your lifetime that was tax-free, and that changed back in 1997. And now you can, I guess, take advantage of some tax-free income by living in a house 2 out of 5 years. It doesn't have to be consecutive. And again, with the depreciation in, you know, Jackson, Michigan, and other places in the country, you can sell that house tax-free up to $500,000 exclusion on a married couple filing joint, and then $250,000 on a single individual. So if you think about that, that's a lot of money you can avoid tax.
So there's other places, or is it this universal?
Universal,
Okay.
Yep, across the United States.
So sell your home. The gain from what you paid versus what you sell for, tax-free.
Yeah, if it's your principal residence, yes. You know, and the other thing to think about too is a lot of people live in their homes a long time. I'm not sure how long you've been in your current residence, but they do a lot of projects. I'm sure maybe you've done a kitchen or you've done maybe asphalting the driveway, whatever that may be. It's nice to have a folder at home that you save that documentation on. So later in life, everybody kind of knows what they bought the house for because there's records, but you don't remember all the improvements that you've done over the course of that home. And those costs you get to subtract too from that gain. So that makes a difference too. But
if you
had a gain, correct.
Yeah. The timing, as you mentioned before the death of the person giving the home versus after the death, that makes a difference.
It does make a difference. A lot of people, there's lots of reasons maybe from an elder care planning standpoint that maybe they want to gift it out before they die, but the basis is going to be at the date of their gift, whatever their basis is. So the step up comes after death. And that step up makes a huge difference from a perspective. So the ideal situation is to wait till after death to gift that. But that's from a tax perspective. It may not be from an elder care perspective.
Should people be getting their tax advice from someone like you or someone like Tom Selleck?
Probably somebody like us, and they should also probably consult with an elder care attorney with reference to, you know, an elderly parent's estate or whatever and how they handle that. because there's a lot of different planning things, and sometimes taxes isn't always the thing that should wag the dog. It's not the most important thing, but sometimes it is. So you got to really evaluate the situation.
14 days, you were telling me about this.
A fun tax rule, and it's funny, we've had 2 different individuals bring this rule up, and I've never heard it referred to as the Augusta rule, but basically with like MIS close by and things of that nature, there's a weird code section that allows you to rent your house out for 14 days or less tax-free, and you have to pick it up on your tax return. You have to cite the code section as relevant to that, but you will not pay tax on that income. So if you had a large corporation coming into Jackson for like the race at MIS, or something, maybe they wanted to be on a lake because there's a lot of lake houses and a lot of real estate. From that perspective, you could ultimately not pay tax on 14 days of rental. So,
wow.
Yeah, so we've actually had a client in the past that had rented to a large company and did not pay that tax. So it was a really nice, moment for her from that perspective. And if you think about it, there's death and taxes. There's not many things that aren't taxed anymore. So this is just kind of a weird loophole.
Yeah, and it could be significant if you've got,
If we had
big wheels coming in.
Yeah, or the Olympics, who knows? Maybe we'll get the Olympics in Jackson or something like that, where something is a longer period of time and somebody's going to pay big dollars for your house. So yes, but MIS in the day, I'm not sure how much it is today, but in the day there was a lot of big companies flying in, and there was a lot of that going on.
Yeah.
So.
Well, I think that's still the case. I think there are still yeah.
Yeah.
All right, so Brandon keeps asking me if I were to win the Powerball, how much I would give each person that worked here at JTV. So I might consider the tax implications before I make a decision on how much. Because last week I told them everyone here is going to get $1,000.
Wow.
But I might change my mind if there's tax implications.
Well, from a family perspective, because usually when you're gifting employees, it looks like comp. Sometimes you have to be careful. But if you have children that are buying a new home or starting up from a perspective, and you're wanting to reduce your estate, your taxable estate, you can gift, $18,000 a year. So if a husband and a wife could give $18,000 a piece to that child, and then they could give $18,000 a piece to their spouse too if they chose to, and it gets the money out of their estate and ultimately may help their kid. And they get to, I guess, gifting it while they're alive, they get to see what the kids do with it. Hopefully they approve, and they get to watch the kids enjoy it, where sometimes that's not the case, obviously, after they're dead. They don't know how they spend the money, they can't control it, but at least they know while they're alive they get to watch that moment. So, and there's some big changes coming. I think Brian touched on some of the stuff earlier, but with the tax laws that'll be sunsetting in 2025, one of the changes will be that there's a unified exemption for estates, and that's at like 12.6 a piece right now, and that's going to drop, or 13.6. It's going to drop back down to approximately 6 million. Nobody really knows, but in 2026. So individuals that are very wealthy or whatever have an opportunity to gift away money out of their estate right now, and they won't pay tax on that gift. And the people that receive those gifts historically don't pay tax on it. It depends what the gift is. Like if you were to gift, if you passed and left me your IRA, I would pay tax on that because that has not been previously taxed, or maybe an annuity. But most other items, if you had General Motors stock or something from that perspective you left a loved one, they would get your basis at date of death and wouldn't really pay tax on it. So it's a nice ability to do something like that.
As we have more and more people at retirement age, we've got the question, when do we take out, when do we cash in any of our investments, or if we have IRA, or if we have Social Security, should we delay? There's a lot of complications with that, with taxes.
And there are a lot of complications, and really with the taxes, there's a lot of different opinions, like Social Security. It depends really who you talk to. I think you can always find the opinion that you want, probably, if you opinion shop a little bit. There's an individual I listened to speak that says, don't take it out till you're 72, 73, and to me, I look at it as when I'm full retirement age, I'm okay. At 66, 67, I'll probably draw mine at that moment, just because, when you pass away, whatever you've paid into your Social Security goes away. So why do I want to draw money out of my retirement plan that I can leave to a church or leave to some type of organization or to my kids, where the Social Security just disappears? So there's a lot of different reasons not to.
Yeah, use your social.
Use Social Security first, absolutely.
Yeah. And there are, and I think there's a misconception that Social Security benefits are not taxed, when in fact,
Yeah, that's a great point. They are taxed. They're not taxed at the 100% level, but it depends on your income. So one of the things that you can do if you have a Roth IRA, there's planning opportunities depending on your income level so that you can avoid getting that Social Security tax in your earlier ages. And you can take the Roth or use cash that you've saved while you were working to avoid dipping into your retirement. And they keep pushing, it used to be 70 and a half, I think it's 73 now, or they keep moving that back. So when you have to, or you're required to take your required minimum distributions.
yeah, it has to start.
Yes, at some point.
Now, so there are tax implications. There are some retirement accounts that are deferred tax, and others that you pay tax upfront and they're tax free, essentially. If you were to pass away and then those accounts are inherited, do the tax, whatever the tax implications with those accounts get inherited too?
Yes. Yeah. So yeah, if they've deferred the tax, then you're going to inherit it and you'll end up paying the tax after death. So, but yes. And the rules are complicated, and we're always available. If somebody has questions, they want to reach out to us or anybody in our office, they certainly can do that from a perspective. There's a lot of good professionals in the community, and you really should use them at times when you need them. I understand we're expensive, but I think the value's there, especially in a lot of moments that people make mistakes as they go forward.
Well, so you can save a lot of money by doing it yourself, but you could also be losing a lot of money.
Absolutely.
Because you're making the wrong, you don't have you're not the trained professional.
And you may never know you lost the money, because you don't really know the rules and you just move forward. So they say sometimes ignorance is bliss, so.
And the rules, the laws, they're constantly changing.
They are constantly changing. It seems to ebb and flow with the politics and who's in office. So I think the next presidential election will see some changes. We haven't seen a whole lot yet, but I think there will be some more significant changes. If nothing else, the laws that are in place right now automatically sunset unless they don't approve to keep them going. So several of the laws that were put in place under the last administration will go away.
And you don't anticipate, because this is an election year, there's not going to be any big...
There's so much fighting going on. I have a hard time anybody agreeing on any type of change to make it happen.
Yeah.
There's actually a proposal right now to retroactive some changes within the tax code, and that would go back and change everybody's, well, everybody's, but it'll change some people's tax returns last year. I don't know if that'll pass yet or not. You'd think it would have passed already, but there's talk. So we'll see how that all shakes out.
And all those COVID benefits, like the ERC, everything, it's done, right?
There's still some people, I think, working with the ERC, but pretty much it's done. The ones that I think qualified have filed, most of them. But they've put a freeze on that right now from an IRS perspective because there's been a lot of fraudulent transactions in that area. So I think they're trying to sort through all that.
Yeah, and it's too bad if people waited, but they waited too long.
And I'm sure they got about 4,500 phone calls and about dozen or two emails and everything else, because there was a lot of companies out there that were really pushing that from a perspective. So
yeah, I guarantee you every business got inundated with offers to help.
Absolutely.
So
Absolutely.
If you missed your boat, you missed your boat. All right, well, we appreciate all the advice and help. And
it's a pleasure as always, Bart.
people, if you have any questions or want to see Rick or any of his great team at Willis and Jurasek, they'd love to hear from you.
Absolutely.
All right, great to see you. Thanks, Rick.
Yeah, thank you.
From Willis and Jurasek, CPAs and consultants, CPA and principal, Rick Schefferly.